Today, the House of Horrors, the DFA Daily to the 20th of June 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's post, we pick apart the horrors of Australian housing, look at a horror story from US housing, and also touch on the question of whether the US SEC will regulate cryptos, which could also have its own horror story attached to it. The Australian nightmare looms, even as Frydenberg prepares his election pitch, wrote Peter Harcher in the SMH. Josh Frydenberg now has enough talking points to get him all the way to election day, he wrote. The recovery of the economy is strong, and as we learnt this week, unemployment is back to its pre-pandemic level, and the minimum wage is to go up by 2.5%. And of course, as a bonus, the super guarantee levy is about to be hiked to 10%. This is pretty good for the country that is still emerging from its worst downturn in a generation, but how good is the economy? After the first recession in nearly 30 years, the Australian economy is roaring back, the Treasurer told the House on Thursday. An economy that is bigger, an economy that is stronger, an economy that is leading the world. Today, we saw unemployment fall for the 7th consecutive month to 5.1%, he trumpeted, smashing market expectations. Participation was up, underemployment was down. And that's all true. And of course, Frydenberg has had a little help from the Reserve Bank Governor Philip Lowe, who pointed out this week that it is also worth recalling that the economic recovery is being underpinned by unprecedented fiscal and monetary policy measures that will not last forever. So, okay then, a tremendous amount of support. Still, we're going to go to election day hearing Frydenberg tell us that everything is perfect, yet improving. But look at the other economic news this week. Home ownership is now out of reach for Australians under the age of 35, according to a new report from the University of New South Wales City Futures Research Centre. 70% of all housing wealth in Australia is now concentrated in the hands of those over 65, and the rise in house prices in the biggest cities is simply ridiculous. Take the price of the median Melbourne house. It hit $908,000 last month, according to CoreLogic. To reach that level, it increased by almost $800 each day, every day of the year to date. Or Sydney, the price of the median Sydney house reached $1.186 million last month, which represented a daily price rise of $1,220 for every day of the year to that point. So, if you were aged 21 to 35 and earning the national average income for people in your age group, which is $58,635 a year, the price of a Sydney house was rising every day by an amount equal to 1 week's wages. The message to average Australians is to despair of being able to do what your parents very likely did, buy a home. What, he said, a brilliant national achievement. We've priced the next generation out of the ability to buy a home. We have only 26 million people inhabiting an entire continent, but cannot supply affordable housing in our major cities. It's pretty crazy in many parts of the rich world at the moment because interest rates everywhere are so low. But there's only one city in one country where the price surge is crazier this year, and that is Vancouver in Canada, again according to CoreLogic. And besides, this acceleration is just the latest in a long-running national failure. Historically, housing affordability had been similar between nations until a few decades ago, said the 2021 Demography Survey of International House Prices. For example, national price-to-income ratios were 3 or less in Australia, Canada, Ireland, New Zealand, the United Kingdom, and the United States until the late 1980s or 1990s, meaning that you could buy the average house on 3 times the average annual wage. Since then, the ratio has increased to 4 times average incomes in the US and Canada and a whopping 6 times in Australia. Only New Zealand is worse over those decades, with the ratio increasing to 7 times income. This is, he said, a generational betrayal. Every Australian in my generation or older who thinks he or she is a brilliant investor because of fat housing price profits is simply a participant in the betrayal of the next generation. Another piece of news this week was the performance of the Australian share market. The ASX 200 benchmark price index surged to new all-time highs on 4 successive days to peak on Wednesday at 7,406. That up 62% from its pandemic low point just 15 months ago. And it's 10% above its level at the opening in 2020. Once again, this is cheery news if you happen to own a bunch of shares or you have a solid superannuation balance, because the typical super fund is mostly invested in Australian shares. But if you don't, and if you're on wages, the situation is not so happy. Frydenberg's budget fully expects that wages will be rising so feebly that they will be outpaced by inflation. In other words, the purchasing power of the average wage will be going backwards this year, and real or inflation-adjusted wages are forecast to stay flat for years. In sum, asset owners are getting richer at a rapid rate, and income earners are facing stagnation. If this persists, it would represent a new phase in Australian equity. Andrew Leigh is a federal Labor MP who also happens to be a world-class economist and an expert on the subject of inequality. The story of inequality in Australia over the last 30 years has been about diverging labour incomes, says Leigh. It's been a fanning out of wages. Lawyers' wages went up faster than cleaners' wages, and it's partly a tech story. But the next generation of inequality could well be the divergence between workers and capital owners. The returns on shares and properties in the past year have been astronomical, and the underlying drivers of that are likely to continue: low interest rates and a tax system that encourages investment in housing. As for shares, he cites likely enduring factors such as high commodity prices, soaring tech company valuations, and increasing priority on health services. Leigh, a former ANU economics professor who's written several books on inequality, says you move increasingly into a two-class society. It becomes multi-generational as one group of people passes their houses to their kids and another group has nothing to pass on. This would put Australia into Piketty territory, he points out. Thomas Piketty is a French economist whose 2013 book Capital in the 21st Century became a shock bestseller. A bestseller because it was bought by many, a shock because it verged on being unreadable. Piketty's essential point was that there was a central contraction of capitalism, where the rate of return on capital exceeds the rate of economic growth. Unless there's a countervailing force, this creates a persistent inequality that ultimately destroys democratic societies. You can make a good case that this is what has been happening in the US, where shocking inequality created the political marketplace for Donald Trump's destructive populism. Trump then had a red-hot go at overturning the US election and installing himself as, well, an unelected autocrat. Leigh says that so far, Australia has not experienced Piketty's contraction of capitalism, but that it now looms for Australia if we enter an era where asset owners consistently earn higher returns than the rest of the population. In other words, that today's Australian reality settles in for the long term. Frydenberg has a talking point on that. His strategy is to drive unemployment down so low that employers are forced to pay higher wages for their workers. Wages growth accelerates and, hey presto, problem solved. But unfortunately for the Treasurer, the Reserve Bank Governor has a counterpoint. In a speech this week, Philip Lowe said that while the conditions were in place for wages to go up, they just were not. The sheer volume of stimulus is unprecedented. Unemployment is falling and workers are scarce in many sectors, but employers are not offering higher wages. And why not? partly because state and federal governments have held down the wages of their workers, the public service, and partly because bosses have a fixed mindset that they can't raise prices. If profits can't be increased by expanding or by raising prices, then it has to come by achieving lower costs, said Lowe. This mindset can be helpful in making businesses more efficient, but it also has the effect of making wages and prices less responsive to economic conditions. In other words, Frydenberg's plan isn't working to lift wages. It might eventually, but so far there's no hint of that. Of course, Lowe could help by raising interest rates. That would sober the housing market, but the Reserve Bank says its main job is to keep rates low to help deliver economic recovery, not to try to control house prices. And it's true that there are multiple causes for raging house prices. Low interest rates, certainly, but also the government's federal tax policies and the way that state and local governments manage stamp duty, land releases, zoning, and building approvals. So the big question for Frydenberg is this: if your plan to raise wages isn't working, what are you going to do instead? Don't expect him to answer this before the election. It's too hard for a government uninterested in real economic reform. Labour has an opportunity to answer the question in the meantime. Australian inequality will never be as bad as America's, not so long as we have policies like Medicare, the NDIS, and a compulsory superannuation levy. But if wages continue to stagnate while asset prices soar, inequality will tear at the social fabric. Australia will never be American, but it certainly could be less Australian. And if you think our property market is overdone, how about this from a Colorado Springs agent, which was reported in MarketWatch? Available homes are so scarce that this nightmare listing seems like a steal, even though it's covered in graffiti and smells awful. This realtor is keeping it real, maybe a little too real. While many listings that describe homes for sale are notorious for spinning cramped, dark spaces as cozy or glossing over other inconvenient truths about a property, a Colorado Springs agent didn't pull any punches in her roughly $600,000 listing for a formerly majestic 5-bedroom home that is now, quote, every landlord's nightmare. It's covered in obscenity-laced graffiti and smells like there's a dead body there, Mimi Foster, a real estate agent with Falcon Property Company in Colorado, told MarketWatch. Yet her front listing that describes the damage done to this home in gruesome detail has gone viral since she posted it 3 days ago. What's more, Foster has also received multiple offers, many in cash, and above the $592,500 asking price for the home she describes as a little slice of hell. All seems well on the outside of this available Colorado Springs home, but the inside stinks and is covered in graffiti. When MarketWatch asked Foster what she felt while walking through the house for the first time, she said, horror. This is not your typical fix-up and flip, she said, as in buying a dilapidated property, renovating it, and then selling it at a profit. This is, well, mayhem. It's like walking into a crime scene. And a visceral reaction bleeds through into her blunt Redfin listing. Do not go on back deck. Do not open freezer in basement, warns the ominous post. So what happened to this place? Well, a woman who had been living there for a decade stopped paying rent and was evicted in 2019. She was allowed back to pack up her things and trash the house instead. You will also notice that there is not one surface of the home that has not been enhanced with black spray paint or a swinging hammer, reads Foster's post. If you dream of owning your own little slice of hell and turning it into a piece of heaven, then look no further. But that's not even the worst of it. The place reeks. The basement freezer, which hasn't had electricity in more than a year, is full of meat that's gone rancid. So be sure to wear your mask, not for anyone else's protection but your own. You may not be able to endure the smell. If you don't, the listing warns. In fact, the smell is so bad that Foster is refusing to accept any sight unseen offer including a California investor whom she says offered her well over the $600,000. It's too much of a liability, she says, noting it will cost at least $150,000 to rehab the home. I don't want to sell it to someone who hasn't seen it. That's also why I wrote the description. If you're going to walk into this household, you need to know what you're facing. And yet, investors are so hungry for any kind of housing inventory right now that the Colorado Springs horror house still looks like a steal. People love a fix and flip, and they're rare now, says Foster. Colorado Springs has 2,500 to 3,500 homes for sale during a normal market, she explains, but there are now only 400 homes available as at last Thursday. So when you have a fix and flip with this neon sign attached, talk about turnover potential. And this aligns with what's been going on in the housing market nationally in the US. Sky-high demand, limited supply, and low mortgage rates has created a situation where desperate buyers are skipping inspections and appraisals, buying homes in cash, and even snapping them up sight unseen. A recent Zillow report found that 47% of homes in the US were on the market less than a week before an offer was accepted, and 76% were on the market for less than a month. Only in this real estate market could we possibly sell the house like this, says Foster, because on the flip side, only in this real estate market could the buyer make enough money flipping it to make it worth their while. And make no mistake, the house has great bones, and it's in a desirable location with great views in a cul-de-sac. The open floor plan boasts a family room with fireplace, a living room, dining room, a kitchen, laundry, a main floor bedroom and bathroom. And there's also a walkout to a back deck. Just the deck is not necessarily attached to the house right now. The upstairs has a catwalk and a large master bedroom with a soaking tub and dual sinks, plus 2 extra bedrooms and a bathroom. But it needs a lot of work and a buyer with a strong stomach. The dream buyer right now is an investor, somebody who knows what they're doing, who has to come in and make this livable again, she says. And finally, for today, the US Securities and Exchange Commission, the SEC, has released its regulatory agenda, which does not mention Bitcoin or cryptocurrency regulation. The Office of Information and Regulatory Affairs released the Biden administration's spring 2021 Unified Agenda of Regulatory and Deregulatory Actions last week. It details the actions administrative agencies plan to issue in the near and long term, which provides important public notice and transparency about proposed regulatory and deregulatory actions within the executive branch, the accompanying announcement explains. Included in the agenda is the SEC's annual regulatory agenda. The agency independently clarified the announcement, saying the report, which includes contributions related to the Securities and Exchange Commission, lists short and long-term regulatory actions that administrative agencies plan to take. Some of the items the SEC will consider include disclosures relating to climate risk, corporate board diversity, and beneficial ownership and swaps. The SEC will also focus on rules relating to SPACs and short sale disclosure reform. And the SEC chairman, Gary Gensler, commented, "To meet our mission of protecting investors, maintaining fair, orderly and efficient markets, and facilitating capital formation, the SEC has a lot of regulatory work ahead of us. I look forward to collaborating with my fellow commissioners and with the dedicated staff to propose and finalise rules that will strengthen our markets, increase transparency and safeguard investors." And while Bitcoin and cryptocurrency are not on the SEC's regulatory agenda this year, Gensler has been talking about the need to protect investors and to regulate cryptocurrency exchanges. In fact, last month, the chairman urged Congress to pass cryptocurrency legislation to protect investors, adding that cryptocurrency exchanges needed more regulation. And in addition, the SEC cautioned investors about funds trading in Bitcoin futures last week. So far, the agency has brought 75 crypto-related enforcement actions, and meanwhile, a growing number of companies are seeking approval to trade Bitcoin exchange-traded funds. And Goldman Sachs has taken a step further in its efforts to assist hedge funds and other large institutional clients in betting on Bitcoin. On June the 18th, Goldman Sachs began trading Bitcoin futures through Mike Novogratz' Galaxy Digital Network. That's a cryptocurrency merchant bank, which is paving the way for banking institutions. Galaxy Digital announced the agreement as part of Goldman Sachs' crypto investment strategy. According to CNBC, the bank has started trading Bitcoin futures in partnership with Galaxy Digital, founded by Mike Novogratz. Under growing demand from institutional clients, in March, Goldman Sachs reopened its crypto trading desk after a 3-year hiatus. The desk is part of the bank's US Global Markets division. According to Galaxy co-president Damian Vanderwilt, this is the first time Goldman has employed a digital assets firm as a counterparty since the investment bank launched its Bitcoin desk last month. The recent moves by Goldman Sachs, the world's largest investment bank, may have effect on Wall Street and beyond, as banks increasingly face pressure from clients who seek Bitcoin exposure. Goldman is effectively providing other banks permission to begin trading cryptocurrencies by being the first large US bank to do so, according to Vanderwilt, a former Goldman partner who joined Galaxy last year. There's a whole dynamic with the major banks that I've seen time and time again. Safety in numbers, Vanderwilt said this week in an interview. Once one bank is out there doing this, the other banks will have to because of fear of missing out, and they'll have to get on board because their clients have been asking for it. Galaxy has made many high-profile moves in recent months, including a succession of purchases of digital asset management companies, Vision Hill and BitGo, the latter of which Galaxy purchased for $1.2 billion in May, are among the acquisitions. And Galaxy's acquisitions have more than doubled the firm's comprehensive income since 2020 and are part of its pathway to a US listing later this year. According to multiple sources, Goldman Sachs is the first bank in the United States to actively trade cryptocurrencies, and Bitcoin and cryptocurrencies are viewed by many fiat banking institutions as a financial bubble. After more than a decade of existence, many financial experts feel crypto is still a hoax. But as a result of the new Goldman Galaxy Corporation, consumers will put pressure on banks to expose their customers to cryptocurrency, and banking organizations will be obligated to gratify their clients as the pressure to give Bitcoin intensifies. So as a result, as more financial institutions back the currency, global acceptance perhaps will rise. As a result, Bitcoin may become available in even the most remote corners of the market. So as a result, as Bitcoin's adoption grows, perhaps volatility issues will diminish and eventually disappear, but on the other hand, perhaps not. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.